Well, the first thing I want to ask you, let's quote Warren Buffett here because he says, "Price is what you pay, value is what you get." And you spoke about evaluating a business. How is a business evaluated to be sold?
Yeah. Well, I mean, the market is obviously, you were talking about, some larger companies there at the beginning of the program. And, those businesses at the very high end, that's a different beast in terms of how those are valued versus, things at the lower end of the market. And what really drives that is probably the capital that's going after those kind of, like the people behind the capital. So it might be an actual, entity, like a Warren Buffett's company, or it might be a private equity or an investment bank or something. And when you're looking at smaller businesses, like the type of business I bought, you're looking at an individual is going to buy the business. And so what governs, I think, what a company can sell for is really what that individual has in terms of capital to basically buy the business and then to run it with working capital. And when you go out to borrow money to buy that business, you go to a bank or whatever and get an SBA loan. That's where, at the end of the day, a bank is going to look at debt coverage ratios, and I don't want to get too technical here, but that's going to put a ceiling on really what is going to allow a business, in terms of a ceiling on what its value can be.
Now, I want you to get a little technical there. You said, now how is this ceiling determined?
Well, I think it's determined because it's the bank is going to look at what can we finance for this business based on what its cash flows are. And what kind of risk are we willing to take? Obviously you have this cash flow coming from this business. The buyer wants to borrow money to buy the business, and I think that's kind of where those factors drive what's going to ultimately drive what the person's or what the bank's willing to lend, and then what the person can actually get as in terms of selling the business.
So one of the big factors you're saying is the cash flow. How
Yeah.
much money are you making? Pretty much.
Well, yeah, and with a with a buyer, you want to look at you got to look at yourself, and you have to say, okay, well, what how much money do I have to invest? How much money do I want to make? And then from those things we can kind of help them. You can figure out basically what size business it would be appropriate for you. So when we value businesses, there's lots of different methodologies. There's like a discounted cash flow. There's there's doing comps. It's just like a market approach. There's like several other ones. But at the end of the day, I think really what drives an investor is sort of hey, if I invest money and buy this business, they're buying cash flow. They want to get a certain amount of money back and make a return on that money, right? Okay. So that's really where what someone's willing to pay.
So let's say, for example, I want to earn $100,000 as a business owner. How much you got to say that company is probably going to have to be? How much I'm probably going to have to put out to buy a company to be able to earn $100,000 as an owner?
Okay. Well, businesses usually at this end of the market that I'm in, which is say businesses that sell between $500,000, maybe up to $10 million. Those businesses usually go for between 1 and 3 times what we call seller discretionary earnings. Seller discretionary earnings is basically the amount of money that you make, the profits you make on the business, but we add back the depreciation, amortization, interest, as well as the owner's salary. Because at the end of the day, the buyer is buying a business to make a livable wage. And so that's part of that overall investment or return that they're looking to get from the business. That number is going to vary between 1 and 3 times. And it's going to all come down to sort of what the quantitative and qualitative aspects of the business. Obviously, the better the quantitative aspects of the business, the higher the multiple. But qualitative aspects, obviously if the owner of the business isn't directly involved in the business,
okay.
They're not a revenue producing role. If you have owned a landscaping company, if you're mowing the lawns, that's gonna hurt their value. If you're not mowing the lawns, you have other people doing that for you, that's gonna help improve the value. So those are things you can't put like a number on it, but those are things that kind of qualitatively, help improve what the value of the business is going to be.
That's interesting that you said that the more work Because, let's say if you own a company, you're looking to sell it, the more work you do, it actually hurts the value of your company.
The more involved, I mean, you want to, I want to qualify that because, a lot of times we're talking to buyers and, they're turning a chapter in their life. They want to, look at, maybe they're leaving corporate or they want to just make a change in whatever they're doing and they want to buy and run their own business. They've kind of fancied that. I think one of the things is that, buyers have this mindset like, well, I'd like to just buy a turnkey business or a semi-absentee business or absentee business. And I'm always a little bit befuddled by that because it's like, if you think about like a Jack Welch who ran GE, I mean, he's pretty much hands-on the entire time he was running his company, or even Warren Buffett, take for example.
Mm-hmm.
So why wouldn't a small business be the same thing? I mean, the small business at the end of the day is probably going to need more of your time and energy, or should require equal to or more time, in terms of you running the business. So I think that's one of the gut checks you have to do as a buyer, is that are you willing to like kind of dive in and really like learn the business and try to grow the business. Yeah. So